Welcome to The State of Us. Real people with honest opinions and the future of responsible media. Here's your host, Justin T. Weller.
Would it surprise you to learn that wage growth is not meeting most economists' expectations? What about if we told you that countless new hires are making as much, and in some cases possibly more, than seasoned veterans? Well, that's exactly what a recent report from the Conference Board in New York uncovers. From the worker's perspective to the employer's perspective, we all rely on the economy, and that makes this important to all Americans. Today, we're fortunate to get to speak with an economist from the Conference Board that worked on the report. Frank Steemers' expertise is primarily in the analysis of labor market in the U.S. and other mature economies. He's based in New York at the Conference Board and conducts statistical analyses and contributes to labor market white papers, blogs, podcasts, and media engagements. Steemers received dual MA and MSc degrees with distinction in international and development economics from universities in the Netherlands and Germany. In addition, Steemers holds a BSc in psychology. Frank, thanks for joining us today.
Thanks, Justin. Happy to be here.
And of course, we couldn't begin this critical conversation on the economy without
your friendly redneck liberal, Lance Jackson.
Thank you, sir, for taking the time to join us. I am very interested in what you have to say today about wage growth. So without further ado, let's go ahead and get started.
Wages for new hires have shot up while overall wage growth is lower than expected. Why, Frank, should people and organizations care about this unsettling discovery?
Right. So let me first say that you're right. Like, wage growth is maybe slower than some people had expected. It is still lower than in the previous decade, though I do want to point out that we do see that wages have started to accelerate on a national level. But of course, if you dig a little bit deeper into this average, you can see that there's a very interesting divergence if you look at those that are switching jobs, so what we call new hires, and people who are staying at their company, so people who are not switching jobs, which we call existing workers. And there we see a very interesting divergence that actually now people who are switching jobs are receiving much stronger pay increases than people who are not switching jobs. And I think it's very interesting for organizations, and they should definitely take account of this and notice of this, because it has a direct impact on their both recruitment and retention. So, for example, when you think about recruitment, if a company needs to hire a lot of people, then today, in today's tight labor market, they have to pay quite a lot more than they had to do a couple of years ago to get a lot of new people on board. So at the same time, we also see that it's much more difficult to retain people, because people who are still at the company see that that people who have been switching jobs are receiving much stronger pay increases. So we, for example, also see that the voluntary quits rates are now at an all-time high. Mm-hmm. So I think that is, important for organizations to know that there is a very important distinction when you look a little bit deeper.
Yeah, but it's interesting because I've been reading some articles outside, and with like the headhunters and different people going out after workers, because they know what these people are making basically, and they can go out and offer them more. And people are like, well, why should I be loyal to this company or to this owner when I can go do the same job over here with company B and make more money right off the bat? So I'm sure, people are always looking to make more money. And then if you're the owner, if you want to keep your workforce stable, you have to take care of those people that you already have then, correct? Which is why we should see wages growing a little bit more.
Right. So I think what's important to point out here is to understand why we see this divergence. So if you're switching jobs, then companies have to react to market forces. So then companies are competing with each other for like this, for these qualified workers. And we know that in today's labor market, a lot of companies have difficulties finding workers, and it is a much better time for workers themselves, because they can get different job offers, see the different salaries that they get offered, and then maybe choose the best one, negotiate. But people who stay at the company, they don't have another job offer lined up, so they can maybe ask for a stronger pay increase. But it is, as a company, you can more easily turn that down, because the risk that worker will leave is, of course, much smaller because it is in the end still difficult to switch jobs. It is a very big decision still to make.
That is true. So what theories are there that explain why the overall, we talked, the difference between existing workers and new workers, but what theories are there that explain why overall wage growth is lower than expected? And do you feel like any particular theory is more applicable to this situation?
Right. So just from a macroeconomic perspective, so really when we look at overall wage growth, like there are a couple of theories that economists have been talking about. So let me just start with the cost of living. So inflation. We know that inflation has been much lower in this decade compared to previous decades. So we know that the Fed has been trying to reach this 2% inflation target, and this is something they haven't been reaching. So what that means for wages is that if the cost of living is not growing as fast, and also there's less reason for a company to on an annual basis give much stronger pay increases to compensate these workers for this lower growth in the cost of living. Another theory is about productivity growth. So we have a lot of talk about innovations, self-driving cars, but if we look at the macroeconomic data, we actually see that productivity growth has been very slow in this decade. And with productivity growth, we of course are talking about automation, stuff like that, just to get more productive or to get more out of your existing workers. So if you're not getting more productive on an annual basis, then you are not getting much more valuable on an annual basis. So then there's also less reason for a company to give you this stronger pay increase. So this is, besides inflation, another reason why overall wage growth has been lower. A third reason has to do with revenue growth, also has been slower in this decade. So if companies are growing more slowly, then there's also less room for the overall wage bill in a company to grow. And then a fourth reason maybe I want to give here, and that is a little bit more technical, but it has to do with the retiring baby boomers. So we know that there are many people now leaving the workforce. Often these older workers at higher salaries, so a lot of high earners are leaving the labor force, and a lot of young workers are entering the workforce, but they have much lower wages.
So the overall average is lower because you're replacing a higher salaried worker with a lower salaried one in the same job.
Exactly. So that's why I call it the technical reason.
Okay. Yeah. Well, and I understand that because I am one of those retiring baby boomers. So I do understand, how the person who was hired to replace me got about half of what I was making, but that's our public education school, our public education system. So of those four, do you feel like any one of them is driving things? Because if I just look like the cost of living and inflation, I would counter argue that there was a long time when wages didn't go up. And so people are still haven't reaped the benefits, so inflation is not as high, but my money doesn't go as far even because I didn't get a wage increase in the previous decade, or not very high. Inflation was at 3% or what, and the numbers I don't, but inflation was 3%. I was only getting a 1% raise each year. So I lost money for numerous years. So, I can see all four of them making sense. Is there one that you feel is more the reason than the other, or do you think it's just a combination of all four?
I think as an economist speaking here, I think still, like, if we look at the overall wage increases, often we just talk about inflation and productivity growth. I think you're making a very good point about inflation, because what we would call the real wage increases, that of course then is not very different. So I would maybe point at productivity growth.
So productivity growth is probably the one that stands out I would say so. And that's not always the one that people focus on the most either, and I think that was interesting that you brought up the real wage growth. It's like Lance and I have discussed before too, real unemployment, versus, we throw out terms like this a lot. And, I'm sure the Conference Board does a better job than most, but a lot of think tanks, will refer to certain things. And most people, once the news picks it up and reports on it, you say unemployment's at, 2 point something. And people think, okay, so there's only 2% of people who aren't working. And it's like, well, no, that's not exactly what that means, because you have to understand how the term's defined. So I think it's important. And we try to take time, make sure that our listeners, understand that as well. So far we've been talking with Frank Steemers. He's an economist for the Conference Board in New York. and we've been looking at wage growth and why it's not exactly meeting economists' expectations. We've got lots more to talk about. So far, we've already gone over some of the basics, but we're going to dive deeper in the next segment here and get into why the labor market's so tight in comparison to in the past, and also look at pay compression and how this is certainly something you need to be on the lookout for. Keep it right here on The State of Us, and we'll be right back.
We are The State of Us. Here's your host, Justin T. Weller.
Frank Steemers is an economist from the Conference Board in New York. Would it surprise you to learn that wage growth is not meeting most economists' expectations? What about if we told you that countless new hires are making as much and possibly more than seasoned veterans? Well, that's exactly what Frank Steemers' report from the Conference Board in New York uncovers for us. We're fortunate that he's joined us today. So far, we've talked a little bit about overall wage growth and why it's lower than expected, and also looked at the theories that explain some of this. In the next segment here, we're looking at pay compression and also how do wages compare to in the past. And we've already hinted at this a little bit. So, Frank, the U.S. labor market is undoubtedly tight. I don't think there's a lot of debate about that. But how do wages compare to before the Great Recession in 2008?
Right. I think indeed the labor market is now pretty tight. We actually think it is now tighter than it was before the Great Recession. But of course, as you point out, if we compare these two different periods, then we still see that current national average wage growth is lower than it was in 2007. And this is a little strange because we have a very low unemployment rate. There's of course still maybe some labor market slack, like you already touched upon it. In the first segment, the unemployment rate is not, you cannot really compare it always over time, but we definitely know we're in a tight labor market. But I think maybe here I want still below 2007 levels. But if we actually look across different occupations, then we see a very different picture. So what we actually find in this is that for the highly educated management and professional occupations, so that are occupations where you generally need to BA for, they have still much slower wage growth. But if you look at all other occupations, then we're talking about blue collar jobs like transportation, production, maintenance, repair, manual service occupations, but also some sales and office occupations where you don't generally need to BA for to work in. There we actually already see that wage growth is much stronger than it was in 2007.
So you think that part of the untold story here and part of what you've uncovered is that, and this is part of why those top line numbers, while I think important because they provide this overall view, right? They can also be a little misleading because if I'm understanding you correctly, the situation is, yes, the labor market's tight, but it's tight in a different way than pre-2008. And so that impacts obviously wage growth and also what new hires are making. Is that an accurate description?
Yeah, no, that's a very accurate description. I think what we find is that labor markets for the highly educated white collar workers, that one is a little bit looser than for the other occupations. And this is of course also driving these different wage dynamics.
So excuse me, I'm sorry. So the service sector of the employment is actually doing better than the white collar as far as growth in their salary. Obviously, they're not making as much money as the white collar graduate, but they're seeing their income or their growth go up, their wages go up more. Mm-hmm. And then the service sector then? Okay.
Yeah. So I do want to make a distinction here between we see highly educated white collar workers. But there are, of course, also other types of white collar workers, where you don't generally need a BA or more to work in. And there we also see strong wage increases. So it is very focused on those management professional occupations like healthcare engineers, scientists, computer engineers, occupations like that.
Not to get into get into a social science argument with you as an economist, but then why do we hear people, do you think, say that there is this difference between the haves and the have-nots? That should actually be closing then, is if I'm hearing you correctly, in that the higher workers aren't getting the wage increases compared to the lower salaried workers.
Mm-hmm.
So shouldn't that gap be closing, or is there a piece that I'm missing?
No, so actually, so you're talking about wage inequality, if I'm correct, right?
Sure.
Yes.
Yes.
Between white collar, blue collar workers and different occupations in those areas.
Right. So we actually have looked at wage inequality, not to be confused with income inequality, which also takes wealth into account. But if we just look at wages,
Mm-hmm.
then we see that the wages at the bottom of the wage distribution, so that are mostly those people with, or people without a BA,
Mm-hmm.
that these wages are growing faster. So we actually see since, 2014, that there's a potential reversal in the wage inequality.
Okay. That's very interesting. Thank you.
So the future prospect, just to clarify here, Frank, is if I'm, and I'm not, but if I'm a member of Gen Z, right, and I'm looking at the prospect of college, part of what this data tells me is that wage growth for college educated workers is moving slower than wage growth for non-college educated workers, those who are working in trade-based fields, for example. Is that correct?
Mm-hmm. Yeah, that is correct. We actually looked at this and wondered, like, do some young people now decide not to go for this 4-year college degree and directly enter the labor force, since it is much easier now to find, say, a blue collar job. But actually, it still turns out that is not happening. So people are still going for this college degree. I think that many still have a very long-term focus. Maybe still believe that because this is a one-time decision, so over the next decades, it will still pay off. To go for this college degree.
Lance has one more question for you, but if I may,
Mm-hmm.
if you can get to this quickly, part of what I'm curious about, because Lance and I have discussed this before, and I'd love an economist's answer on it. Is there anything to the idea of market saturation in regards to college education? What I mean by that is, if you look at 30 years ago, the percentage of people going to college was less. So therefore, one of the reasons that people with degrees could expect to make more money, at least from a layman's understanding, again, I'm not an economist, is because less people had it. So the market and demand theory applies there, right? Is that these skills were not as readily available. Less people had these skills. So therefore, it commanded higher pay. But now you actually almost have the opposite happening because more people are going to college and less people are going into trade fields. Trade fields are commanding higher pay because we don't have enough people to do them. Is that, am I analyzing that correctly based on my non-economist understanding?
You could almost be a co-author of our report. It's like if I already sent it to you. No, you're exactly right. I don't have anything to add. We see that the U.S. workforce is getting more and more educated. A much higher percentage of people now have a BA compared to previous years, and this continues to increase. So many more people are now entering the labor market with a BA, fewer without a BA, but employees blue collar in manual services or in occupations where they don't demand the BA.
Okay. Well, thank you. Our final question in this segment has to do with a term that I'm not familiar with, so I'm looking forward to the answer. You mentioned in your report from the conference board the term pay compression. What is pay compression, and why should workers and companies be concerned about it?
So with pay compression, we basically mean that the wage premium that you would get for working longer, so for experience, is shrinking. So say you entered in 2010 the labor market with a much lower starting salary because the labor market was much looser. Now 10 years later, you only got your annual pay increases, but now you see new hires entering this company, maybe with a wage that is almost as high as yours. So then you start wondering, how fair is this that I have so much more experience, but I'm not earning much more than this new hire that comes on board with much less experience. So of course, this is creating morale issues. Job satisfaction will be lower, and companies can expect more labor turnover.
So if I again, and I know I'm saying this a lot, I just want to make sure because, we have a lot of different listeners from different backgrounds. And I think part of the reason they tune into our program is they're trying to get an understanding of topics that aren't getting covered as much or covered the same way from mainstream media. That's Lance and I's whole goal on the State of Us, is to provide people this unique perspective. I mean, it sounds like, right, pay compression is basically the term for what I was describing in the opening of the program, which is this concept that new hires are, in effect, making more money than or making as much money in some cases as those who have been in the same position for 5-10 years.
Yes.
Okay.
Yeah, that's correct.
Okay. I thought so. Just wanted to make sure.
So I think as a worker, obviously I know why I'm concerned because, wow, I'm not getting paid value for my experience. And for companies, I think we kind of touched on it in the first segment. It would be my concern as an owner would be I'm going to have a harder time to retain my experienced workers if this continues in this direction, because my experienced workers are going to go out and look for a different job because they're not feeling, like they're being rewarded for their experience. Is that what we're finding or, in the job market?
Yeah. Yeah. So we do see it's not always difficult to leave your company, but we definitely see now with more pay transparency. You have these websites like LinkedIn, Glassdoor. Mm-hmm. You can see what people maybe at your company, in your position, are earning. And if it feels unfair and the labor market is good, then why not try to find a new job yourself?
So we've been talking with Frank Steemers, an economist from the Conference Board and one of the authors of a recent report that uncovers the reality that overall wage growth is lower than expected and that many times new workers are making as much, if not more, than seasoned professionals doing the same job. And we learned that term, to refer to that, is called pay compression. We've been looking at kind of the ins and out, diving deeper. Next up, we've got to talk about what's the future? Where do we go from here? What do we do about this? But before we do that, Lance, it's important that we take a moment and remind listeners why we're here in the first place. The State of Us is part of a network, right? A media network of different podcasts and radio programs. And we all pursue a common goal on this network. What is that?
Well, our mission statement here at True Chat is to educate people by providing honest, open, and respectful conversations.
You can learn more about the State of Us and find all kinds of other great podcasts at thestateofus.org. We've also got linked there books and reports that Lance and I have referenced. And of course, articles in shows as well. We're trying to put more resources there, make it easier for you to engage. If you want to look at this stuff for yourself, when possible, we try to make it available there. So be sure to check out thestateofus.org. We're talking with Frank Steemers, an economist from the Conference Board. Keep it right here on The State of Us, and we'll be right back.
We are The State of Us. Here's your host, Justin T. Weller.
I think it would surprise you to learn that wage growth is not meeting most economists' expectations. What about if I told you that countless new hires are making as much and in some cases possibly more than seasoned veterans? Well, that's the reality, folks, and we're talking about it today on The State of Us. We've talked about the term that describes that, called pay compression. We've gone over why overall wage growth is lower than expected and tried to put it in historical context. Now we get to talk about, since we understand, hopefully, what's going on now, what's the future? Where do we go from here? One of the main goals of The State of Us is to discuss solutions and or talk about actionable items. And it seems that some workers are reluctant to switch jobs, Frank, even though they might benefit from doing so. So what are some practical things that workers could do to navigate this labor market wisely?
So I think first of all is to be aware that currently the labor market is much healthier than it used to be. So we see that more people have a chance to find a job. We see that more people who were not looking for a job yet or looking for a job before have started to do so and also have had better chances in finding work. So that is one. I think if you have found a company or a few companies where you want to work, be aware that you have much more bargaining power. So don't directly accept the first offer. See what other companies are offering you, because companies are now competing for you instead of you competing to get into these companies and competing with other workers. I already mentioned it. Just know what you can be paid, know what the benefits are. So look at Glassdoor, look at LinkedIn, which will help for pay transparencies. And I think sometimes when you're not sure if you are able to get a job, still just apply, even if you don't have everything that employer is listing, because we do see that employers, for example, have started to downskill. So they have started to accept candidates that maybe do not have all skills, but they are very willing now to train these workers because they have more difficulties finding the perfect candidate. So I think that is for people who want to switch jobs. Maybe for some people who are not in a position to be switching jobs, that it's still a big step to take. I would then maybe recommend talk to your manager and see if there are other ways that can make your job satisfaction go up. Maybe you can start telework, so work from home. Or maybe you can ask for learning opportunities, which will help you in the end, maybe get a promotion.
Well, very good. What concerns, you talk about switching jobs, but what concerns should I have if I do start to think or decide to switch jobs? Because we know the labor market won't stay this way probably forever. Are there some concerns that I should take into account if I'm deciding to whether or not to take a new job offer or stay with my existing job?
Yeah, and I think you're making a very good point. It's of course, I think still in the back of the mind of many what happened in the Great Recession, and many people got unemployed. So maybe you feel safer in your current job. I think it is just difficult. We currently at the Conference Board don't forecast a recession happening in 2020, but probably at some point it will happen. I would just say that you also don't have any guarantee if you don't want to be switching jobs. So maybe just try to take the chance and go for that new job. Also because we believe with a working age population that is now only slowly growing, tight labor markets may be much longer with us than in the past.
So it sounds like, the biggest thing people can do is, and this is something that Lance and I advocate all the time, is be informed, right? Know what you're getting into, do the research to look into companies, and be willing to, maybe take a few risks in the labor market we're in right now. It sounds like it's worth it. And the other thing is, I think a lot of people, you have to keep in mind, you don't necessarily have to leave your current job to be looking for another job, and maybe just don't be in a rush either, right? In this labor market, it should favor the workers. So don't feel like you have to hop on the very first opportunity, or don't think that the first opportunity is the last. Maybe you take that and, you keep searching for what you're after. Sounds like those are some different things that people could do. You mentioned already that businesses are starting to accept people who don't have all the skills necessary to do the job. But if I were a business owner, should I do to go about acquiring new workers? How can my organization address this tight labor market effectively besides just taking people who aren't really qualified and then training them myself? Are there some other things that my organization could do to attract stronger workers?
Right. So here I maybe want to bring in a survey that we fielded this year. So that we call it the Labor Shortages Solution Survey. And basically what we did, we asked HR executives, what are your strategies to improve your recruitment and to improve your retention? So what we found is that the number one strategy, and maybe not surprising, is to raise salaries. So that is a good thing to know, at least for workers, that is happening. But some other things owners and employees can think about is to improve the recruitment process. We see that from the surveys that many companies that have trouble in finding workers have deployed an employee referral program. So you ask your own employees to help you find workers and give them a reward if they do so. We see what you can do is shorten the recruitment process. So for me, it is interesting, not so much for the employers, but we have heard about ghosting. So people show up for the job interview, accept even the offer, but then don't show up for work. So what you can do is just make the recruitment process much shorter, that you quickly have that person on board. You can work with staffing firms, use social media, and just to retain views, make leaders accountable. So that are some examples. So Frank, one thing is, just about a month or a month and a half ago, we had a couple of your colleagues on from the Conference Board talking about social change and how this impacts organizations. Is that something that you think is also helpful? Part of what we looked at in that is some of these quote unquote perks that organizations offer are nice, but in fact, they're not always main drivers of why somebody chooses to work somewhere, when in reality, social change issues and companies' positions on those often are.
It seems like that's becoming more expected. Do you think that's also something that businesses could be doing to help themselves out in the tight labor market?
Yeah, no, I definitely think so. It's just probably everybody says it on this show. It's a combination of a lot of factors. So besides wages, as my colleagues already talked about, think about the social projects that you're involved in or what your stances are on that. What we, for example, also found from our survey is that to improve the workplace, that many employees are very happy if they get more flexibility, better working conditions, not as much overtime, for example, and also importantly to reduce boring tasks. So I think it all comes down to to talk to your manager as an employee, but also as an employee to talk a lot to your worker and ask them, how can we make it nicer for you to be here besides just paying you a salary?
It sounds like you're preaching Justin's mantra of communication, that the more communication that takes place between the owners and the workers, the less problems you'll have. I think that's a probably wise on all of our parts, right? The more that we communicate, the more we can get along and find out what each of us think, and then we can move on from there. I like that. I like that answer quite a bit. Good job.
Well, I was thinking as he was mentioning it, I was looking at Lance thinking we've talked a lot about how millennials, now that, they're a large segment of the workforce, have been driving some changes. And a lot of what you were mentioning has, especially the flexibility component, I think has a lot to do with what we've seen from millennials, which is this, in a lot of cases for them, work is just that. It's just work, and they're looking for perhaps that elusive and maybe unachievable work-life balance, but nonetheless, it's something that they're actively trying to figure out. And it sounds like that's something that employers can do that has a real impact for all workers, not just millennials, but for everybody that's part of their labor force. If they spend more time thinking about, what can we do to, and that's the reality, right, of a tight labor market, is it favors the workers. The workers get more than they do when the labor market is not so tight, because then companies can demand more and they can be more picky. In this case, they can't. So I think it's been great insight. We really appreciate you sharing all of this. And if people want to learn more about the Conference Board, what's the best way, Frank, for them to learn more about the Conference Board? I
think we have a couple of ways. We have reports, we have blogs. Of course, the first thing to do is often go to the website.
And what is that?
I would say that's the Conference Board, or conferenceboard.org.
Okay. So go to conferenceboard.org. It's a good place to launch from and look at some of those resources you guys have. I know you do your own podcasts, I believe, at the Conference Board, and webcasts and other things.
Yeah.
So
exactly.
So definitely be sure to take a look at all that. And to all of our listeners at home, you can go to thestateofus.org, our website. We try to be good about linking to what we can there. A lot of the stuff that the Conference Board generates is for its membership. So sometimes, like this particular report, we wouldn't necessarily just directly distribute, but we can share with them articles and so forth about this report, other coverage, so that they can read other people's thoughts, not just ours. But we appreciate you taking the time to be on with us today, Frank.
Yeah, great. Thank you for having me on your show.
Yes, thank you very much. We appreciate your time. So, Justin, we talked about wages and pay compression and what owners and workers can do. What segment of this do you think is the most important for us to take away today?
That's a good one. I think while understanding the concepts are critical, I think a lot of his advice here at the end, Frank's advice, was what, if I was going to say, if you're not going to listen to anything else, listen to this. Because for a lot of people, and we've talked about this before, it's part of the whole voting thing. A lot of people just don't have the time or inclination to learn all of it, right? And to really understand it. And I think we did a pretty good job breaking it down. But at the same time, I think the most practical thing, and a lot of our listeners, right, they're listening because they want to know. But if you're listening and you're going to go share this with somebody, the part to share is the last part. If you're going to repeat something, repeat that, because you might lose them with wage compression and the labor market's tight. They might say, who cares? And we know you care, but if you're sharing it with somebody else, go right into the, hey, I learned on this podcast today, right, that the labor market's really tight, and here's what it means for you. Here's what you can do about it. Here's the advantages it brings you. I think it's the big one from the worker perspective. And from the business perspective, then it's probably a little bit more important you understand some of the concepts causing this, because you don't want to make short-sighted decisions. I think a lot of times in business, we're focused on the long term, right? We have to think about the short term, but it's the long term too that's important.
I agree with you. I think that's probably the most important part for our listeners. I enjoyed the part where he was talking about why wage growth was lower in the first section.
I did
and he
too.
mentioned the cost of living and revenue growth, productivity growth, and the baby boomers. Yeah, kind of the historic ideas. And I think the one he kind of, as an offhand remark or kind of a throwaway remark, said that I would like to really dig in with him in the conference board. He said, we don't predict a recession in 2020.
Yes.
And I
saw you.
I really think, I know that I'm a glass half empty kind of money guy. So I think there will be, I think the political stage is set for there to cause some kind of slowdown. Now, what counters that, my thought, and not getting into presidential politics, but I think that's going to play a big role in it, is also the deal with China.
Sure.
Is the United States, is Trump holding out the trade deal to hit it this coming summer, right before, as the election starts to heat up, and he makes this wonderful trade deal with,
sure,
he'll say it's a very, very wonderful trade deal, but any positive trade deal for the United States with China at this point would boost the economy right before the election.
Right.
But there will be a hard fall in 2021. There are so many things that come into this and that's where, as a worker, you have to stop and think. It sounds like a great time to switch jobs. Well, I'll switch jobs. Okay, you switch jobs and the economy goes down a little bit and they start to cut back. You may go first, and you had a fairly decent job with somebody that you'd been there 5 or 6 years, and all of a sudden that seniority that wasn't worth, I'm air quoting here, any money, was worth job security.
Well, and then part of that too, though, right, is that one of the reasons that the recovery from the recession was a little sluggish out of the gate is because people were, even though they had the money, they were afraid to go spend it.
Right.
So there's that, you have to be careful of, it's that balance, right? You don't want to be overly risky, because that can in some ways cause a recession. But if you're too conservative, that can have the same effect if people aren't willing to take the risk. So just make smart decisions.
This just opens up a whole lot of things that you can talk with your friends and your co-workers about.
Lots to think about for sure. So Lance, we've challenged people, right, to bring others into this conversation. That's part of what makes this an effective dialogue, that mission to educate people by providing those honest, open, and respectful conversations only works if other people tune in.
That's right.
And so we're a syndicated radio program and a podcast. So there's a lot of different ways to listen. But if you were going to invite some new people to listen, how would you tell them to tune in?
Well, I would tell them that they can get on, if they have the Stitcher app or Spotify or Apple Podcast. Any of those work, as well as any other place that you might listen to podcasts.
For The State of Us on True Chat in Urbana, Ohio, I'm Justin T. Weller.
And I'm Lance Jackson.
Thank you so much for tuning in. We'll see you next time. Be the change. Be sure to check out our website, thestateofus.org, for books, articles, and all the ways to tune in. thestateofus.org.